Chris Gonzaga says, when we were talking about being a real estate investor, he goes, it's a good road, but bumpy, which I think is another thing to talk about, right? Yeah. It's this idea. We were just talking about it this morning on the run.
Yeah.
That it's, if your 401k is doing its thing and you are, I don't know, 45, 50 years old, stock market takes a tumble, right? Like we go into a recession. Your spouse is not sitting there at the dinner table saying, man, I told you not to put money in the 401k.
Yeah.
They're not saying, what's up with Fidelity? Why isn't Fidelity? That's not what Fidelity promised us, right?
Right.
Yet, when we think about the real estate piece, if we are doing it, and let's say you have a turn, 1 year, and then a year and a half later, you have an eviction.
Yeah.
But all this time, your house is worth way more than it was worth before. And maybe you lost, I don't know, worst case scenario, 6 months of rental property income in having a vacancy that you had to go change because there was the turn and you had to put a little bit of money into the property. Your net worth still would be higher than that money in the 401k that just took a beating over a recession.
Right.
And yet you're sitting there cursing this real estate investment.
Yeah.
And that's the bumpy road.
Yeah.
Is thinking, man, this thing, I have a different relationship with this thing because I expect it to do all this other stuff that I've never put the expectations on my Fidelity 401k. I say Fidelity because I was the company that managed my 401k the last time I was working corporate.
Right.
And yet your net worth is still way higher and your path to retirement is still much closer than it was before, regardless of that vacancy or eviction or foreclosure or whatever it was.
Yeah. It's like, define bumpy. What's bumpy mean?
Yeah.
Does bumpy mean that your actual value of your assets go way up or way down? Because that's the S&P, right? That's your typical 401k that's in stocks and bonds, right? It goes way up, it goes way down, right? That might be somebody's definition of bumpy. But in real estate, we talk about how bumpy it is, but your swings, your volatility is like this.
Yeah.
Right? Even if you have a big turn and it costs a few $1,000s.
Yeah.
Right?
The volatility of your net worth.
Yeah.
Right?
Yeah.
Because if my net worth is in the market and it takes a 15% haircut, my net worth just went down 50%.
Yeah.
If I have to evict a tenant and it costs me $20,000.
Well, that's really high, but okay.
Super high, right? Let's call it super high.
Yeah.
But my net worth of what that property is worth, what I can liquidate it for, and what I have options to like do with that net value. Yeah. Still there.
Yeah. I mean, so like, we'll just run crazy numbers here. All right. Let's say that you had $20,000 of expenses that like hit your bank account for your rental property because of all these crazy things you're talking about, but it's a $200,000 asset. And it appreciated 10% in that year, which is actually low compared to what it did last year. It actually appreciated more.
Yeah.
But you'd be net neutral as far as your volatility of net worth in real estate. It's just about the pain points. In traditional assets and stocks and bonds, it is built in such a way to shelter you from the pain points, right? But ultimately the asset is way more volatile. Yeah. So like, what do they do to make sure that it shelters you? Well, it's through your company 401k plan. So you didn't even see the money. It didn't even come to your bank account and then you invested it. No, it was invested before you even made your net paycheck. Yeah. So you didn't even feel it. You feel like it's just money that's given to you. Yeah. Right. And then, it is an asset that does not have the ability, if something goes wrong on a monthly basis, it doesn't have the ability for a capital call from you. Right. You don't have to reach into your bank account to pay for whatever stocks, bonds related. It is what it is. But at the end of the day, so that's all really good stuff. Yep. But at the end of the day, the asset value goes up and down like this. I mean, we're down 15% from a previous high, which was last year in the S&P 500. It's down 15%. So at the end of the day, the most important thing is way volatile, but the experience of owning it is so easy and so simple. So it lulls people into thinking that it's a better asset. Yeah. On the real estate side, and this has been our mission for creating this company, is how do we deconstruct this to improve this? But the real estate side, the rental property side, does such a good job of pointing out and putting in your face all of the negative things on the experience side but the asset that's underlying it is incredibly stable and consistent and grows more than the stock market. So it's, you know, what happens on the real estate side that you're all probably worried about, you know, it's if a tenant moves out, it's a big expense. I might have to dip into my pocket to pay for it. That's a capital call. Capital calls in general real estate, that's a thing you got to be worried about. JWB, we do a lot of things to mitigate that risk. So if you have a question about how we avoid that for our clients, you should be talking to us, because that's not the same risk that you face as a JWB client.
And if you want to talk to JWB, go to chatwithjwb.com.
Yes, you should talk to us.
Helping
about
you
that.
out here, bro.
Yes, thank you. You know, and all of the benefits that come along. Well, and then there's all the teammates that you have to handle, you know, to do typical real estate. You know, your real estate agent, contractor, your property manager, financing, insurance, everything is a different person. So, and then, you know, when something positive happens, you don't actually feel it in your bank account most of the time, because your biggest profit centers are home price appreciation, principal pay down, tax saving. So all of those hidden things create this incredibly powerful, consistent asset, but it's largely hidden from view on the rental property side. But that's why we have an opportunity to build a great business. If it was easy, everybody'd be doing it, everybody be investing in it. So
Chris Gonzaga from the illustrious Hudson Valley also says those bumps are also, by the way, tax shelters when it comes to real estate.
There you go.